Welcome to the Deep Dive, the show that cuts through the noise to deliver the insights you need to be truly well informed.
Hi there.
Today we're embarking on a really fascinating journey into something that sounds simple but is profoundly difficult in the world of investing.
Mhm.
What really makes a fund successful, beyond the daily headlines and the market chatter.
And at the heart of today's deep dive is something truly special. Fundsmith LLP's annual letter from January 2020 to its investors.
Oh, okay.
It's not just a report, it's really a masterclass in transparent, conviction-driven investment.
Right. So our mission today is to extract the absolute key insights from this letter. We'll explore Fundsmith's strategy. It's a pretty impressive performance through 2019.
Quite impressive.
And the crucial lessons drawn from a significant financial year and, well, a major industry event, too.
Yeah.
We're going to unpack how a consistent, almost deceptively simple approach can lead to remarkable long-term results, and what powerful lessons can be drawn from both successes and setbacks in the investment world. This is designed to give you that essential shortcut to truly understanding what works.
So where do we even begin with Fundsmith? How about we start with their incredible track record over the past decade?
Okay, lay it on us.
From its inception, November 1st, 2010, right up to December 31 in 2019, the Fundsmith Equity Fund achieved a cumulative total return of, get this, plus 364.4%.
Wow. 364%, that's staggering.
It is an annualized return of plus 18.2%.
So when you compare that to the benchmarks over the same period, I mean, the difference truly jumps out, doesn't it?
Oh, absolutely. The MSCI World Index was up plus 180.3% cumulative, so plus 11.9% annualized.
Okay. Still good, but nowhere near Fundsmith.
Right. And UK bonds.
Yep.
Just plus 40.9% cumulative or plus 3.8% annualized.
Ouch. And cash. Forget about it. A mere plus 6.0% cumulative, that's plus 0.6% annualized.
So what does that kind of consistent outperformance tell you about their approach? It's not just luck, clearly. No, not at all. It tells you they're not just winning. They're like operating in a completely different league.
Yeah.
And 2019 was no fluke either. Fundsmith was up plus 25.6%.
Again, beating the benchmarks.
Yep. Again, outperforming the MSCI World Index at plus 22.7% and the FTSE 100 at plus 17.3%.
And here's where it gets really interesting for me. Since its inception, this fund stands as the #1 performer in the Investment Association global sector,
That's right, number one.
by a cumulative margin of 233 percentage points above the sector average. That's not just beating the market, that's leaving it in the dust.
Exactly.
So when you look at that kind of consistent sector-leading performance, what were the top drivers for 2019 specifically? What stocks really moved the needle?
Okay, so for 2019, the top 5 contributors to the fund's performance were Microsoft, adding plus 2.7%,
Okay, big tech.
Estee Lauder, plus 2.1%, Facebook, plus 2.0%,
Interesting, Facebook.
PayPal, plus 1.8%, and Philip Morris International, contributing plus 1.4%.
Yeah. What stands out to me here is the consistency you mentioned earlier. Microsoft is making its 5th appearance as a top contributor,
5th time, yeah.
and PayPal is in its 3rd year running. But I'm also curious, considering how controversial maybe Facebook was back then,
Definitely.
and even Microsoft previously had its doubters. What does this list tell you about the conviction behind Fundsmith's picks?
It speaks volumes about conviction and, really long-term view.
Yeah.
They're clearly not swayed by short-term sentiment or media noise.
Stick to their guns.
They do.
Mm.
And it's also insightful to look at the bottom 5 contributors for 2019.
Okay, who lagged or didn't lag much?
Exactly. None were significant detractors, actually. 3M was down just menace of 0.2%.
Fairly noticeable.
Right. While Colgate-Palmolive, Clorox, and Brown-Forman were all basically flat, 0.0%.
Yeah.
And Reckitt-Benckiser was actually up slightly, plus 0.2%.
And during the year, they actually sold stakes in 3M and Colgate-Palmolive, didn't they?
They did.
For 3M, it was, growing doubts about management's capital allocation decisions.
Yeah, that was the reason cited.
And for Colgate-Palmolive, they just sort of got tired of waiting for an effective growth strategy.
Pretty much. Patience ran out. It shows they're not afraid to cut ties when a company no longer fits their core criteria, even if it's not losing money dramatically.
Right. Discipline again. And what about new buys?
They started acquiring Brown-Forman. That's the distiller of Jack Daniels.
Jack Daniels, okay.
And Clorox. And it's worth noting, Brown-Forman's share price weakness coincided with EU tariffs on American spirits.
So they saw an opportunity there, perhaps, despite the short-term headwinds.
Seems like it, illustrating that they look for fundamental value, even with temporary issues clouding the picture.
Okay, so impressive returns, clear conviction in their picks. But what about the other side of the coin? Risk.
Yes, crucial point. Performance without understanding risk is incomplete. And Fundsmith's approach to risk is just as revealing as their returns.
Hmm.
The letter introduces the Sharpe and Sortino ratios. Might sound a bit like gobbledygook to some.
Ah, yeah. Can sound like jargon. Let's unpack these a bit. For those deep in investment metrics, you'll know these are crucial. Sharpe A ratio. Think of it like efficiency, right?
Exactly.
It's not just about how much money you make, but how much risk, like volatility, you had to take to get there.
Precisely. A higher Sharpe means you're getting more bang for your buck in terms of returns relative to the total risk you're enduring.
So how does Fundsmith stack up?
Well, Fundsmith's ratio since inception is 1.22. Compare that to the MSCI World Index's 0.63.
Wow, almost double. So they've delivered roughly twice the return per unit of total risk.
That's the takeaway. And the Sortino ratio, that's arguably even better
How so?
because it focuses only on downside variability. I mean, why should we penalize a fund for volatility when it's going up? That's the good kind.
Good point. We only care about the risk of losing money.
Right. So Fundsmith's Sortino ratio since inception is also 1.22, while the MSCI World Index is lower at 0.59. Again, about double.
So similar story. They get more return for the bad kind of risk.
Exactly. The profound insight here is that Fundsmith isn't just delivering high returns. They're doing it with remarkable efficiency in terms of the risk taken. Less bumpy ride on the downside.
And this remarkable efficiency in managing risk ties directly into the very heart of their philosophy, doesn't it? That three-step strategy.
Mm-hmm.
So deceptively simple, it almost sounds too good to be true. Buy good companies, don't overpay, and do nothing. Let's break down this powerful simplicity.
Okay, first, buy good companies. But what does good truly mean in their book? It's not just a feeling.
Right, it's quantifiable.
Yes. They look at the financial characteristics of their portfolio on a look-through basis, sort of peering through the fund to the underlying companies, and compare it to major indices like the S&P 500 and FTSE 100.
And what do they find?
What you see consistently are superior metrics. For example, in 2019, Fundsmith's portfolio showed a return on capital employed, or OCE.
ROCE, key metric.
Absolutely key. Theirs was 29% compared to just 17% for the S&P 500 and FTSE 100.
That's a big difference. Why is ROC so important?
ROCE is brilliant because it tells you how effectively a company is using all its capital, debt, and equity to generate profits. A high ROCE signals a business that's, really a master of its craft, consistently making excellent returns from its assets.
Okay, makes sense. What else?
Well, their portfolio also consistently demonstrates higher gross margin, higher operating margin, and better cash conversion compared to these major indices.
So more profitable and better at turning profits into actual cash.
Exactly. Furthermore, the weighted average free cash flow growth for their companies was a robust 9% in 2019. These aren't stodgy businesses. They're growing their cash flow.
And here's a detail I found surprising, actually. The average year of foundation for companies in the Fundsmith portfolio is 1925.
Yeah, isn't that something?
This isn't about chasing the latest hot startup. It's a preference for established, proven businesses that have, well, stood the test of time.
That's a huge insight right there, betting on longevity and proven strength, not just novelty.
Okay, so that's buy good companies. What's step two?
Step two is don't overpay. So while they buy these great companies, they are acutely aware of valuation.
Right. Quality is one thing, price is another.
Precisely. The portfolio's free cash flow, or FCF, yield, that's the annual free cash flow per share divided by the share price.
Okay.
It moved from 4.0% down to 3.4% during 2019.
Meaning the shares got more expensive relative to their cash flow. They became more highly rated, as the letter puts it.
Exactly. They became more highly rated.
How does that 3.4% compare?
Well, it's lower, meaning more highly rated than the S&P 500's median FCF yield of 4.2% and the FTSE 100's median of 5.5%.
So their companies are valued a bit higher by the market. Doesn't that contradict don't overpay?
But this is crucial. As the letter states, and I think this is key, highly rated does not equate to expensive any more than lowly rated equates to cheap,
Okay, explain that.
especially for fundamentally better companies with superior quality. It's about value for quality, not just finding a low price tag, irrespective of the business.
I see. It means paying a fair price for a truly wonderful business, understanding that its inherent quality, its higher ROCE and margins, justifies a premium valuation.
You got it. It's not about buying cheap cigars with one last puff. It's about buying businesses you want to own forever at a reasonable price.
Okay. Good companies, fair price. What's the third step? Sounds like the easiest, but maybe the hardest.
Do nothing.
Do nothing.
This strategy means minimizing portfolio turnover. In 2019, they actually had negative portfolio turnover, which means inflows covered any sales needed for redemptions.
Wow.
And the voluntary dealing cost, the cost of actually choosing to buy or sell, was extremely low, just 0.005% of the fund average value. Tiny.
It's remarkable how low that turnover is. Didn't you say earlier 10 companies in their portfolio have been held since the fund's inception in 2010?
That's right. 10 stalwarts held for the entire decade.
This adherence to do nothing must have a big impact on costs, right?
Absolutely. It directly connects to cost savings. We often hear about the ongoing charges figure, or OCF,
Yeah, the standard fee number.
which is 1.05% for Fundsmith in 2019. But, importantly, that doesn't include dealing costs, brokerage fees, stamp duty, market impact.
Ah, the hidden costs. For many investors, this can significantly eat into returns, especially with active funds that trade a lot.
Exactly. This is where their total cost of investment, or TCI, comes in. It includes those dealing costs. For 2019, their TCI was 1.06%.
So only 0.01% higher than the OCF.
Just 1 basis point, or 1% higher than their OCF. The letter notes, this is the lowest increase among the 15 largest UK funds, highlighting their efficiency. Minimal hidden costs.
But they also caution against obsessing only about charges, don't they?
Yes, very important point. The letter cautions against obsessing over charges at the expense of performance. It's a powerful insight. A cheap fund can still be expensive if it underperforms badly. What matters is the net return after all costs.
And the performance speaks for itself. When you look at the 3-year and 5-year cumulative performance rankings of those same 15 funds, Fundsmith consistently leads. 56.6% for 3-year, 132.2% for 5-year returns. It's a clear example of what you get in return for the fees and a testament to the power of that do-nothing principle.
It really is.
I imagine for many investors, the do-nothing principle is probably the hardest to adopt, though. We're kind of wired to do something, aren't we? Fiddle with things.
Absolutely. It cuts against every instinct, especially when markets get choppy.
Speaking of choppy markets, let's talk about navigating market noise. The letter mentions currency fluctuations and the perennial value rotation debate.
Yes, 2 factors that actually adversely affected the fund's performance a bit in September and October 2019. Cost them about 6% relative performance during that short period.
Okay, so first, currency movements. How do they handle that? Over 60% of the portfolio is in U.S.-listed companies, right?
That's right, with about 40% of underlying revenues actually generated in the USA.
So a stronger sterling would hurt returns measured in sterling.
Correct. But Fundsmith's view is that currency movements are basically unpredictable. They compare it to a game of snakes and ladders,
Oh, okay.
and they believe these movements are best ignored in the long run. When you think about what truly drives a company's long-term success, innovation, brands, management quality, currency swings are rarely the top factors.
Right. Focus on the business fundamentals, not the fleeting exchange rates. Makes sense.
Then there's the value rotation debate. The letter aptly calls this a hardy perennial. It pops up every few years.
Yes. The idea that beaten down value stocks are finally going to outperform those high-flying quality or growth stocks.
Exactly. The assertion that quality stocks like Fundsmith holds are expensive and that neglected value stocks are due for a comeback.
What's Fundsmith's take?
Well, the letter points out, rather pointedly, that this same assertion was being made back in August 2012.
Oh, really?
Yeah, commentators are saying quality stocks may today be considered expensive, and yet those allegedly expensive stocks have delivered a lot of superior returns since then.
So history hasn't exactly borne out that prediction consistently.
Not so far. The deeper insight here, according to Fundsmith, is that what looks cheap on paper often comes with hidden risks or fundamental weaknesses. There's usually a reason it's cheap.
So what's Fundsmith's core critique of value investing itself? Why not just buy cheap stocks?
Their argument, fundamentally, is that low valuations often exist because they're simply not very good businesses. Maybe they're in declining industries or poorly managed.
Okay.
This creates a headwind for value investors because the intrinsic value of the business itself may not grow or might even erode while they wait for the market to recognize the supposed value.
So the cheap stock might just stay cheap or get cheaper.
Or require the company to fundamentally change, which is hard. And unlike quality investing, which lends itself to buy and hold, Value investing often requires constant selling of stocks that have reached fair value and finding new undervalued ones.
Which means more trading, more costs, more chances to be wrong.
Exactly. More dealing costs, more decisions. This brings us to a really powerful insight from Charlie Munger, they quote.
What about Buffett's partner?
The same, he said. Over the long term, it's hard for a stock to earn a much better return than the business which underlies it earns.
Oh, okay.
If a business earns 18% on capital over 20 or 30 years, even if you pay an expensive-looking price, you'll end up with one hell of a result.
So the underlying business's return on capital is the ultimate driver of long-term stock returns, more so than the starting valuation.
Munger argues it's almost a mathematical certainty over long periods. And this highlights a unique characteristic of equities: retained earnings. Profits not paid out as dividends are automatically reinvested by the company.
Right, compounding within the business itself.
Yes. They cite the S&P 500 example from the 20th century. 80% of the total gains came from companies' earnings growth and the reinvestment of those earnings, not from changes in valuation multiples like the PE ratio extending.
So the key insight here isn't just about picking companies, it's about shifting your entire paradigm, maybe. From trying to time market valuations to focusing on owning great businesses that compound value internally.
That's the essence of it. That's the real shortcut they advocate.
Which leads us to another famous quote, this time from Buffett himself.
Ah, yes, the classic. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price.
Sums it up perfectly.
And it reflects Buffett's own journey, heavily influenced by Charlie Munger. He moved away from his mentor Benjamin Graham's pure cigar-butt value approach towards Philip Fisher's quality investing, focusing on companies that can grow and compound value over time.
Buffett also famously said in his 1989 letter something like, "Time is the friend of the wonderful business, the enemy of the mediocre."
Exactly. And you can really see this difference in long-term performance. The letter compares the MSCI World Value Index.
Okay, the benchmark for value stocks.
From its peak in 2007, just before the financial crisis, to the end of 2019, it was up only 49%.
49% over 12 years. Not great.
Not great. In contrast, the S&P 500, which peaked around the same time, had already regained its high by 2013.
Much faster recovery.
And by the end of 2019, it stood 189% higher than its 2007 peak.
Wow, 189% versus 49%. That starkly illustrates the difference between maybe waiting for something cheap to become less cheap versus owning something wonderful that just keeps compounding its value.
Precisely. The siren song of value investors, predicting this gargantuan reversal back to value. Well, the letter argues they often have no idea when that might happen.
The timing is always the tricky part.
And if you've been following that advice and holding value stocks, it would require a truly massive, almost unprecedented turnaround just to make up for the gains you've foregone by not owning quality. And, crucially, the underperformance could just continue.
So what about diversifying? Some commentators suggest holding both quality growth and value strategies, kind of hedge your bets.
The letter pushes back on that, too. It points out that Warren Buffett has pretty comprehensively disproved the idea that there's no harm in just diversifying across styles.
How so?
By highlighting examples of immensely wealthy families: the Betancourts, L'Oreal, Browns, Brown-Forman, Walton's, Walmart, or Bernard Arnault, LVMH.
Right, dynasties built on single businesses.
They became extraordinarily rich by concentrating their investments in single, high-quality businesses and, crucially, not trading them, regardless of short-term valuations or market fads.
That's a powerful counterargument to the idea of just blending conflicting strategies and hoping for the best. Real conviction in quality.
It is. Which brings us sort of naturally to another major topic in the letter: the lessons from the Woodford debacle.
Ah, yes. That was huge news in the UK investment industry back in 2019, a real shockwave.
A massive shockwave. Woodford Investment Management's demise and the suspension of withdrawals from its main fund raised critical questions about fund structures, liquidity, and manager behavior.
So what does the Fundsmith letter identify as the core problem there?
The core problem, as identified in the letter, was what they call a lethal combination.
Legal combination. Okay.
A daily dealing, open-ended fund, meaning investors expect to get their money out any day.
Right. Instant liquidity, supposedly.
Holding significant amounts of unquoted private companies and illiquid small quoted stakes. Stuff you just can't sell quickly.
So a mismatch between the fund structure promising daily liquidity and the assets actually held.
Exactly. This wasn't unique to Woodford either. The letter notes it also affected UK property funds after the Brexit referendum, and again with the M&G property fund around that time. They had to gate too.
Because you can't sell office blocks or shopping centers overnight to meet redemption requests.
Precisely. It created an illusion of liquidity that just collapsed under pressure when too many investors wanted their money back at once.
What's a less realized cause for this problem, according to the letter? Something beyond just the manager's choices.
Yeah, this is interesting. The letter suggests a contributing factor was the rise of these big investment platforms.
The online supermarkets for funds.
Right. Many of them only admit daily dealing funds onto their platforms. This effectively forces fund managers, even if their strategy involves less liquid assets, into this potentially inappropriate daily dealing structure just to get distribution.
Wow, so the platform architecture itself might be creating systemic risk, like trying to fit a square peg and illiquid strategy into a round hole, a daily dealing fund structure?
That's the argument.
Yeah.
It's like trying to fit that square peg in a round hole, creating hidden dangers.
So how does Fundsmith contrast with this? What's their stance on liquidity?
Well, Fundsmith has had a very strong focus on liquidity from the outset. They've even published a liquidity measure right there on their fact sheet since 2012. Transparency.
What does that measure show? And what do they invest in?
They only invest in large, generally very liquid companies. At the end of 2019, the average market capitalization of their holdings was a massive $114 billion.
Huge companies.
And based on trading volumes, they estimated they could liquidate 57% of the entire fund, sell more than half of it in just 7 trading days, without significantly moving market prices.
Okay, that sounds pretty liquid for an equity fund.
Very liquid. While they rightly point out only cash funds can guarantee 100% immediate liquidity, Fundsmith believes it's one of the most liquid equity funds out there. Interestingly, they note even some FTSE 100 companies are among their least liquid holdings, which tells you about the overall high liquidity profile.
So this rigorous approach to liquidity is a direct contrast to the Woodford situation and really a crucial aspect of their investor protection.
Absolutely. Built into the process.
Another question arising from the Woodford incident was this whole notion of star fund managers. People followed him based on his past track record.
Right.
But the letter challenges this term star fund manager, doesn't it? What do they say is the real issue?
They argue the real issue isn't usually about being a star, it's about style drift.
Style drift, meaning?
When a manager changes the very strategy or approach that originally brought them success, they start doing something different.
How did we see this play out with Neil Woodford, according to the letter?
Well, Neil Woodford's past success at his previous firm, Invesco Perpetual, came from some astute, big-picture calls like avoiding tech stocks before the dot-com buzz.
Right, I remember that.
And avoiding banks before the 2008 credit crisis. Big, successful contrarian calls based on avoiding certain sectors.
Okay.
But with his own firm, the letter argues, he invested in a really wide range of companies with, quote, no common theme, many of which all subsequently fared badly.
A scattergun approach, almost.
Seemingly. Combined with those very illiquid, unquoted, and biotech investments. That shift away from his original successful avoidance strategy towards picking speculative winners across the board was the style drift.
He changed his game, his style, and the results were, well, disastrous for his investors.
Exactly.
So what about Fundsmith then? What assurances do they give investors that they won't fall prey to this style drift themselves? How do they keep themselves honest?
Well, they argue they've gone to great lengths to prevent style drift and be transparent about it. They published an owner's manual right at the start, clearly outlining their strategy.
Okay, like a mission statement.
Yes, they issue these detailed annual letters, like the one we're discussing, explicitly reviewing the strategy and performance against its principles. And they hold public annual meetings where any investor can turn up and ask questions directly to the manager.
Face-to-face accountability.
Exactly. They argue it would be extraordinary for them to fundamentally change strategy without investors noticing, and frankly, without their own stated conviction being completely undermined.
And critically, reading the letter, they seem to have absolutely no desire to change their strategy anyway.
None whatsoever. They state very clearly they are convinced their existing strategy, buy good companies, don't overpay, do nothing, is the way to deliver superior long-term returns.
Even if, say, a big value rotation is anticipated, they won't jump on that bandwagon.
Explicitly not. They state they will not switch to a value investment approach just because it might be fashionable for a while. The letter concludes that section forcefully. There will be no style drift at Fundsmith.
That's a powerful statement of commitment to their principles. Discipline, again.
Consistency and discipline are the watchwords.
So wrapping this all up, what does all of this mean for you listening today? We've really dived deep into Fundsmith's approach here.
Hmm.
We've seen the power of a clear, consistent, and yes, disciplined investment strategy focused on quality, long-term holding, and rigorous cost awareness.
Yeah, it's about trusting the business, the
Huh.
underlying engine of value creation,
Yeah.
much more than trying to predict the market's day-to-day whims.
So, a final thought for you to maybe mull over.
Okay.
For you, the listener, consider this. In a world constantly seeking the next big thing or obsessively predicting market rotations, what if the most powerful investment decision isn't really about what specific stock to buy next or when exactly to sell?
What if?
What if it's more about truly recognizing what constitutes one of those wonderful companies Buffett talks about, and then having the conviction, the discipline to simply
Wow.
do nothing?
Let the compounding work its magic.
What might that seemingly simple yet actually incredibly difficult approach mean for your own long-term financial journey?
Something to think about.
Definitely something to mull over until our next deep dive.